Have you ever pondered how the UK market could potentially impact India's Nifty 50? You see, there's an intriguing connection between these two markets. Let's start with understanding the Nifty 50. It's an index representing 50 of the largest and most actively traded stocks on the National Stock Exchange of India. It's a barometer of the Indian economy, reflecting the financial health and investor sentiment in the country. Now let's turn our attention to the UK market. As one of the world's leading financial hubs, the UK market commands significant global influence. Its performance can create ripples that are felt in markets across the globe, including India's Nifty 50. When we talk about financial markets, we're talking about a global interconnectedness. A butterfly flapping its wings in London can cause a hurricane in Mumbai, so to speak. Market movements in the UK can trigger reactions in the Nifty 50. Understanding this relationship can give us valuable insights into market trends and future predictions. To appreciate the impact, we must first delve into the historical performance of the UK market and Nifty 50. Over the past decade, the UK market and Nifty 50 have painted two distinctive pictures. In the UK, we've seen a roller coaster ride with significant peaks and valleys brought on by events like the Brexit referendum and the COVID-19 pandemic. In contrast, India's Nifty 50 has experienced a more consistent upward trajectory, buoyed by robust domestic consumption and growth in sectors like IT and pharmaceuticals. Now, let's consider the interplay between these two markets. The UK's economic events often send ripples across the globe, affecting emerging markets like India. In the aftermath of Brexit, for example, Nifty 50 experienced a period of volatility as investors anticipated changes in trade and investment flows. On the flip side, developments in the Indian market, like the rise of the IT sector, have drawn significant UK investment, influencing the performance of UK-based funds with exposure to India. These comparisons shed light on the fascinating dynamics between these two powerful markets. Now that we have a grasp of their individual performances, what does the UK market's influence on Nifty 50 really look like? Well, the UK market has a significant impact on Nifty 50, and here's why. The UK, being India's top investor, has a direct influence on Indian stocks, including those listed on Nifty 50. When the UK market thrives, it often translates into increased investments in India, boosting the performance of Nifty 50. Conversely, any turbulence in the UK market can send ripples across the Indian Ocean, causing tremors in the Nifty 50. Changes in the UK market can also indirectly affect Nifty 50. For example, the Brexit referendum caused uncertainties that impacted currencies globally, including the Indian rupee. This in turn affected the profitability of Nifty 50 companies with global operations. For investors and the wider market, these impacts underscore the importance of monitoring global economic trends. In a world where markets are more interconnected than ever, understanding these relationships is not just useful, but vital for any savvy investor.